Welcome everyone to Admiral Markets. Welcome to our trading room here, Forex trading of course to be precise. And we're going to take a look at the Forex pairs, the currency markets, and see what could be interesting today to maybe trade or maybe wait later today. So first of all though, we have our PowerPoint that we always go through to explain some basic things first of all before we actually look at the charts with the technical analysis on our vision. First of all, the disclaimer though, explaining that the online material here is made for global audience. It may not be suitable for everyone. To get the corresponding info on charting conditions and other details, take a look at admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Then the risk disclaimer explaining that trading for exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information, and this webinar is for educational purposes only. Roughly speaking, this is always a good model to work with to understand whether you have a trade setup or a trade. There's a difference between the trade setup. There's a difference between analyzing and actually trading. There's a difference between having an idea what you think price could do or actually wanting to trade it. Just because we have an idea what price could do doesn't mean we want to necessarily trade it. I mean, I have at any moment, at any time, I have probably 99% of the time I have a preference for one side or another just based on all the information the market can give us. Looking at candlesticks, price action, structure. Do I want to trade it 99% of the time? No. I don't think our role should be market makers. So we have to structure our analysis and setups in a way that we understand what's going on if we want to trade it. And using this module, we can understand if it's a setup or a trade. And the difference is between a setup and a trade is very important, because if there's a trade setup, doesn't mean necessarily we want to trade it, right? Not at all, in fact. There could be a trade setup and it doesn't turn into a trade and we're very happy, or maybe sad, but that's life. That's why we wait for a confirmation, for instance, or something that tells us that our analysis is correct. And by using this module, we avoid or try to avoid overtrading and chasing trades, which primarily are the main psychological, or at least good reasons why traders make losses and have bigger losses than we should have, right? If we just make sure that our losses are small in risk percentage, that's an important part of risk management, then we should fare already pretty well just with this simple trick in a way. So first of all, one of the important things of the model is defining the trend and whether we want to trade with it, against it, or if we want to trade when there's no trend. But we still need to define it. Then we're looking for opportunity. What is an opportunity? Is it a pullback? Is it divergence? But just because we have an opportunity, just making thing then you want to establish a trigger. At what point are we getting interested? The line's in the sand. Between this and this point, price is not interesting. But if it reaches this level, then I'm interested. If it reaches the 50 fib, then I'm interested. But it doesn't necessarily mean that we have to enter right there, right then. No, certainly not. We can then decide what entry method we want to use. Just because there's a price is hitting the 50 fib doesn't mean we have to enter at the 50 fib. The entry could be upon the candlestick formation at the 50 fib. It could be the fractal break, the first fractal break in the opposite direction after it hit the 50 fib. There are tons of ways. And that's something that can be decided. Then, of course, after this is the analysis and entries. Then, of course, you have your trade management and trading psychology. The trade management is to plan the trade. The trade psychology is to trade the plan. So that's where trade management and trading psychology come in after this module. So first you have this 5 steps. After you've entered, then it's up to trade management and trading psychology to bring the trade to successful completion. And what is the definition of successful? It's following the trade plan, in fact. Alrighty. Admiral Markets in social media. There it is. And with that said, let's take a look at our calendar here. There it is. Got USD quadruple sales. Not much news on the euro. No big pound fundy. Relatively quiet morning regarding the news. Only some euro news, Italy to be precise, Italian retail sales, and consumer confidence. Euro dollar. So today is reversal trading. And well, funny enough, we already talked about reversal trading partly yesterday. For those that have joined yesterday, we talked about the reversal trading. There are a lot of ways you can trade reversals. So, you know, price action, candlestick patterns, trading off of fibs, trading using moving averages, trading using trend lines. There are many ways. Basically, you can categorize them in roughly like 2 different categories. First is a very early reversal trade. Second is kind of like more waiting for the follow-through reversal trade. What I mean with that is, if you look at the euro dollar, now I forgot my drawing tool again, sorry. If you look at the euro dollar, right? What you see at the top, if you managed, let's say, theoretically, you took a sell somewhere in here, where I have the red circle, right? Well, that's an early reversal trade because you're trying to catch the top. Early reversal trades are basically trying to catch it roughly at or just below the top. Okay, you don't want to maybe trade it too far away from the top because sooner or later you're going to bump into support because we're in an upward downtrend, right? We're in a trend. So if you catch it too late, then you're probably shorting or longing it right in front of the consolidation point. If you would have gone short here, let's say, and wouldn't have been aware of this support, then you would have been caught, might have clicked the trade out somewhere where I have the green circle, and then you see it just fall your way and you think, oh my, I just missed the best trade ever. But there was nothing wrong with the idea, it's just the execution, the entry was off. It was too late, it should have waited for the consolidation first and then maybe traded the reversal somewhere, some different way. This is just a theoretical example. I mean, not saying the euro dollar is the best example, necessarily the best example here, but just to give you an idea. Okay, so now the confirmation reversal trade is basically when you get a good move down like this and you're waiting for the second push through or the third push through, but you already had some retracement before that. So you're not trying to catch the top, you're trying to catch the follow-through retracement. It has the advantage that normally or usually you see already a momentum. You see here momentum in the market. That gives us an idea that there could be another momentum. Could be. Doesn't have to be though, because if price would have broken above this triangle, then most likely wouldn't have happened. And this was the end of the correction. That's it. All right. But in this case, we did get a follow-through, and that's the second type of reversal trading. Now, one way of catching the top is by candlestick patterns. Engulfing twins, wicks, pin bars, you name it. Those are reversal candlestick patterns, right? Other method, of course, is waiting for big fib retracements. Looking for price to basically hit a big fib retracement level, a daily fib like the Aussie, for instance. We're looking for the Aussie to hit the 50 fib, just hit the 50 fib. We took a long yesterday, remember? Or I did at least. I don't know about you, but it was here. Right there, it took a long time to develop. Yeah, we'll talk about this trade later. Hit the 50 fib. This is a daily 50 fib. That could be a reversal. That's my point. Off of that big fib retracement. The other, of course, option is a fib target. The target itself could be a turning spot. Let's take a look at this euro dollar. Let's put a fib on this upside. Where did the currency stop? At the minus 272 target. Bam. Bingo. Stopped there, turned around, flew down. So that, of course, is vital in understanding what the market could do, is these targets as well. These targets are the bread and butter of understanding the market structure and where the target, basically the bigger targets are and where the market could head towards. They're invaluable, in my opinion. I paid top-notch dollars for them, in fact, And well, nowadays I guess there's a lot of free stuff out there. It's still difficult to put pieces all together for, I guess, if you don't have if you don't have the mentor. But still, this is good info. Minus 272, minus 618, very important, top-notch targets. Okay, so those are potential reversal spots as well. Then you got, for instance, price action and momentum. Momentum comes in the market, you know, this is probably maybe first part of the correction, maybe. Or at least it's a good correction, right? Sometimes corrections can be slow and tedious like this. If that happens, you want to be extra careful because that looks like a bull flag, and that's a continuation chart pattern, not a reversal pattern, a bull flag at least. Head and shoulders, for instance, is a reversal pattern. And trading the break of the neck of the neckline of the head and shoulders is trading the confirmation of a reversal. Trading the shoulder of the head and shoulders is actually trying to catch it at the reversal spot. That's the difference. So you got chart patterns, momentum, price action, all coming in to understand whether this is a reversal and at what point are we trading it. Then, of course, you got trendline breaks. A break of this trendline and this triangle and this chart pattern was an indication that we're making a bigger reversal. I wouldn't call this a reversal as yet. I would call this a bigger retracement according to my definition, but it depends. I don't want to twist about words here. Break of trend lines. For instance, this one that I have on the chart. But you know, you also have steeper, and you have trend lines with different angles. You got, first of all, the steeper trend line going to break, then the second degree trend line, then maybe even shallower trend line, until basically we're not breaking a trend line but a horizontal line like this. And then the support or resistance is gone. Mind you that support or resistance, horizontal levels are still very important, all right, because they can still provide a bouncing spot. They didn't here in this case, but you have to be aware that they could. Very important. Other than that, you got moving averages as well, right? They indicate potential stopping of the trend, right? When, for instance, price reverts back to its average. What is its target? The first target is the slower moving average, the faster one, then the intermediate, and then the long-term moving average. These are targets. These are spaces for the reversals. And you can see the first drop went all the way to the intermediate. We got a bounce off the intermediate, then went down to the long-term. And now we're stuck in consolidation. You can use these moving averages to have an idea when, when is basically the reversal starting. When you break below the short-term moving average, when you break below these, we have the green circle here, the green-blue circle, then there's a decent chance you can go back down to the intermediate. That's the space for the reversal trade. When you break below the intermediate, there's a decent chance you can go down to the long-term one. Is that always the case? No. Look at this right in here. We didn't get the follow-through there because we still got the retracement before we got the follow-through there. So it's not always, but roughly speaking, when you break these bands, you could expect price to go to the next band. How fast that will go depends. All right? Sometimes it's very, very fast. Look, boom, a drop like never before. Right? A very fast drop. Sometimes it's going to go slow like this. That means that it's more corrective, and we did get a bounce up again. All right? But that's roughly the guideline. Now, these targets become stronger when there's divergence. All right? Then the reversal is more likely. That is, of course, a key element for reversal trading is the presence of divergence on a higher time frame, on multiple time frames, on multiple divergences on one time frame. I'll repeat that. Divergences on multiple time frames, multiple divergences on one time frame, and of course, the higher the time frame divergence, the more reversal we could expect or retracement we could expect. However, the minimum target when we have divergence is the intermediate moving average, the minimum. Now, it doesn't have to always get there, but that's roughly what I'm expecting, the intermediate one. In this case, with the euro dollar, price went to the long-term one. But as I said, that's not a guarantee. Price went back to the intermediate one, but could have continued with the uptrend, really. But the news event sent it down, and price went to the long-term one. That's fine. So we did get followed through. Well, that's just my view of reversals in a quick 15-minute explanation. This was a turbo speed explanation regarding reversals. So what do we have now with the euro dollar? Let's talk about current market structure so we don't bore maybe people who are, that's, you know, for people who are more interested in what's happening right now, right here. But to be honest, I think that it hopefully gave some good, fast insight for everyone. Let's take a look at this euro dollar. 1 hour chart, we got a support resistance line here, and we got a support line too, a new kind of pattern here, a new triangle-ish pattern. Moving averages are saying, well, look at this, it's just caught flat. Moving averages are flat. They're all intertwined. Prices all mixed in there. Is the 1 hour chart a desirable chart to trade? The answer, of course, is very quick, very simple, no. Not interesting. It's a lot of choppiness up and down. And yesterday we did get a break below these moving averages. Sorry, these fractals got a good fall, but then a very strong bounce as well. So it's very choppy. I think looking at the hourly will not provide as much information. We do have a bit of divergence here between maybe these double bottom here. That's about it. I think these trend lines will give a good idea of what could happen. If we look at the 50-minute chart, we can see prices below the moving averages. So if anything, break lower probably could be interesting. A break below these bottoms right in here in the 50-minute chart could indicate maybe a fall right there, because the moving average is already a bit more bearishly aligned on the 50-minute chart. But you can see at the choppiness that it's probably not that desirable to trade, but still an upside would not be interesting for me really until we break the black trend line here. We would really need to have a substantial push up there. Wait, I didn't have the question box open, so apologies if anyone had a question. Didn't see that, so let me open that. I see 2 questions. Okay, I got 2 questions regarding the settings of the EMAs, or what they are. So let me answer that, and in the meantime I'll tell you that basically the euro dollar on a 50-minute chart doesn't look too appealing to me for upside. We'll take a look at the Cameroon indicator in just a second. Let's take a look at the pound dollar first of all. Pound dollar getting a strong bounce actually off support here, off the moving averages. That's one thing when you want to position trade yourself for swing trade. Sometimes you get caught with intraday movement against yourself. Price managed to box itself out of resistance and then started to use the moving averages as support throughout the day, as we can see here, like this. Now, one of the better ways, and that's something I'll explain on Thursday, by the way, how to trade moving averages during the day. We're going to take a look at basic Forex strategies webinar on Thursday. And one of the interesting ways of trading it is, in fact, using moving averages. You can see this was, in my opinion, more bearishly aligned, so I took a very small position trade upon the break, very small risk because I knew there was a difficult trade, but that sometimes can happen with swing traders, that they get caught against intraday. One of the better intraday trades is actually letting price decide a direction in the London morning, the first couple of hours, and then trying to trade about halfway the day, bounces off support like here and here. When there's already some momentum, but it pulls back, some momentum and it pulls back, some momentum and it pulls back. Then going for 20 to 25 pips like that are good daily trades. Now those are with the trend trades on the 15-minute chart. So I don't want to discuss that here too much because it's a reversal trading webinar, but we will dive into that on Thursday, okay? Let me just check this. Alrighty, so Mike and Manuel, I think you should have your answers there. So let me know if anything is unclear, okay? So with that said, you can see we'll basically wait for the 50-minute chart to give us some indication of the intraday direction. Where's the momentum going to that day? And then try to wait for bounces off of support. You can do that with these settings. You could also do different settings. You could do 10, 20, and 50 EMAs. For instance, as I said, yes, there are 5. You have different settings. You could just basically look for the intraday direction and then try to trade off of bounces. Let me try to do that on this chart. Let's do that for the fun of it. Try to make it quick. 1 second. All right. So 10, 20, and 50. Same story, right? Here everything is intertwined, although they were still a bit bearishly aligned, but still we got the twist, in fact, and boom, every time here, then we got the support. This pound-dollar upside, from this perspective on the 50-minute world, doesn't seem that logical if you look at the moving averages. That's okay. Just wait for the first momentum of the day, the first 1 hour, 2 hours, to let the London open, and then normally speaking, you get if you get a good trending day, you would have something like this yesterday. Okay. So anyhow, back to our reversal trading webinar. So if we look at the hourly chart, it looks like with the break actually happening right here, we're getting a follow-through of a reversal. Why do I call it a reversal? Well, the moving averages were bearishly aligned here, right? So to me, price is moving back to the moving averages. If price is moving back to the moving averages, it's a reversal. If price is moving away from the moving averages, it's a with the trend setup or it's a range setup. Depends. Depends if there's an angle of the moving average. Depends on the angle, the spaces between the moving averages. Here, price is moving away from the moving averages, but it's not a trend because the moving averages are all twisted and on each other, and they're flat. So this is a range. Here, price is moving away from the moving averages, and the moving averages were bearishly aligned. This is a trend. That's the difference, right? So I hope that's clear. The blue circle and the green circle there. Trend versus range. If price is going back to the moving averages, it could be part of the range, right? As in here, the green circle, or it's a reversal trade. If there's space between the moving averages, it's a reversal trade. Here there was no space. That means basically it's a range trade. So this is a very simple explanation, but very powerful concept, and very valuable in understanding the market structure, in my opinion. So with this pound-dollar upside momentum, I think it's a good chance we could see intraday upside today, because look, we bounce off the short-term moving averages. This was a bounce or break spot, to be honest. If price would have lingered here and then started to break below, it would have been a breakout to the downside. Price would have been breaking this trend line, and we would have had a good with the trend breakout scenario. Didn't happen. Price bounced off support instead. Now it's breaking above these tops, which means we know that we have a decent chance of going to the long-term moving averages, which is the next set of resistance. So what is the space? Right here. What was yesterday's space? Right here. Did we exceed that? Yes. It's not a perfect. It's anywhere in this band, so yes, it can go a bit higher. First, we had an hour that touched the lower band, and it touched the higher band, and it touched the upper part of the band. Then it made a retrace, and now it's breaking above it. So roughly here in this zone is the target. Yesterday we had this space filled. Maybe today we can have this space filled. Those are reversal trades on the hourly. On the 50-minute chart, it was different. 50-minute chart, bit different. 50-minute chart, we had basically this was bullishly aligned, although we still had the long-term trend moving average above it. So there was a it was half with the trend, half reversal, in the sense that the purple one still was above us. This too. This is half of the trend, half reversal. Why? Because this is already pointed up. So this is an early. This is a confirmed. Now this is the ultra early. This is intermediate, and this is confirmed. Right? There are different stages. When you trade it to the short term, it's very early. From the short term to the intermediate, it's more confirmed, and this is the most confirmed you can have regarding the reversal trading. Different stages of reversal trading. Obviously, as I said, if price is below or above them, that's with the trend. So the downside was with the trend. This is reversal. Reversal, reversal, reversal. Until price gets above it, hooks back to it, and bounces off it, we don't have an official uptrend as yet, though. So that looks interesting for today. Personally, anything like, we'll have to see how it goes. Anything like this or this or this probably is a decent buy for more upside. Let's take a look at the Camarilla indicator, okay? Now, I just noticed some new people entering at this moment. It's a pity that you came a bit later, because we had a full-fledged, or not full-fledged, but a quick, fast guideline and intro, I would say, of various reversal trades using a whole scale of tools. But stick in there. I'm sure we'll discuss it in real life, piece by piece. So, if you have any questions, let me know. H4 on the euro dollar is above the top here. Breakout. H3 short at 138.52. We're at the pivot point there. L4 right here down to L5. Okay, that's the euro dollar Camarilla. And that makes pretty much sense to me, because we want to break off this line here, and then we have that downside trade. That makes a lot of sense. This too. Let's take a look at the pound dollar. Pound dollar is approaching the H3. H4 above 135.67. And L4, let's see, below 164.93, which makes sense, because that would be basically the breakout to the downside scenario. Good. I would say the L5 target, I mean, I wouldn't be surprised if we do break below here, to see further gains down, but the L5 is conservative. Good. All right, so that gives us some information where the pivot point indicators are for intraday, today's intraday trading. Let's move back and talk about reversal trading on other pairs. Now I'm going to use the moving averages to trade reversals, to have an idea of reversals today. If I can find my charts. Doesn't mean that we'll always be using this particular template for reversal trading. The indicator that is showing the targets, I'm not sure which one I talked about. Fibs, I talked about two, Fibs and Camarilla. Camarilla indicator is a pivot point indicator. It's good because it's manually done. I mean, it's automatically done, whereas Fibs have to be done manually. Right, and you need experience to have a good idea where it is. Now, I personally am a big Fib fan. That's also because I know pretty much what the targets, the best Fib targets are. So I would recommend to at least practice it. But there's nothing wrong with using I mean, Camarilla is a very good one. So that's also very recommendable. AUD-USD. We got a break yesterday here, and got the upside after a bull flag to the target, the 50 fib at 92.08. So took a while. We got two bull flags here: impulse, bull flag, impulse, bull flag, impulse. But price, this is a typical example of trending environment where price is above the moving averages, and the moving averages are spaced there. You see. So, you know, this is a currency that didn't make much sense to trade reversals on, to be honest, right? No reversal trading on this AUD-USD yesterday. With the trend mode and looking for reversals doesn't make sense in this case. If you look at the 50-minute chart, and you see prices doing this, that does not make sense to short. Actually, we're looking for longs, don't we? Because it's a bull flag. It's a with the trend continuation chart pattern. It's not a reversal sign. Far from it. Shorting there is seriously has bad profit expectations, or actually has a loss expectation. The only thing that is tradable on this AUD-USD was upside. Now, we did hit the 50 fib, as I said, so that could be a halting point, but it's an early reversal potential. Early, because price has just hit the 50 fib, and we have no guarantee or confirmation the price is indeed stopping it there. Nothing at all. One way of trading it is just taking an anticipating roll right here, right now, and selling it with a 25 pip stop loss, but it's highly risky. Other way is waiting for confirmation, like a 50-minute price action signal, a 1-hour price action signal, like a wick engulfing twins. The other way is waiting for a 50-minute fractal to be broken, or waiting for the 50-minute moving averages to be broken, waiting for the hourly fractal to be broken, waiting for an hourly fractal to form and wait for that fractal to be broken. There are a lot of ways one can trade it, potentially. But it's all early, every one of those. All of this is early reversal signals. Anything that breaks below a chart pattern, anything that already has a momentum like this, then sees a pullback and then sees a breakthrough follow through, then you have a confirmation of a reversal or a bigger retracement. As long as price stays above the intermediate moving averages here, it is trending, and it will be early reversal signals. Do I want to trade a reversal here? Personally, not. If it hits the 61.8 fib at 93.40, then I might think about an early version of the reversal trading. Not here right now, personally. I don't think, looking at the strength of this upside, I think the 61.8 fib seems more likely at the moment. The target than you know, I don't expect necessarily a big bounce off this, so I don't think it's worth it. Basically, I don't think it's worth the risk right in here, in my opinion. The moving average on the hourly charts are very bullishly pointed. They're very strong. They're very good angle. There's a lot of space in between here. Normally speaking, we have some divergence. We don't have that much of a divergence on the hourly, or nothing at all. Let me check. The thing is that we are still building on this. Looks like we're actually going to exceed it. So we haven't finished there. So personally, wouldn't be interested in this. And you can see how these moving averages are providing information regarding different time frames, right? The daily chart, we broke above these tops. Where is the space on this daily chart? Boom, right here. That's the potential space on the daily chart. It's massive, isn't it? So that's why I don't want to short right at the 50 fib, because we just started to break out of a potential smaller, on the daily chart, smaller retracement or maybe bigger retracement. On the 4-hour chart, we're already breaking with the trend because price is above the moving averages. You see that? Whereas the daily, it's a bigger retracement, on the 4 hours with the trend. On the weekly, we're actually, it's a mix of the moving averages. So I don't want to get into that. It's too big of a time frame anyhow. I don't want to bore you with that. 1-hour chart, though, definitely with the trend. And yesterday's long, right in here, was risky, but it did work. And you can see how bullishly aligned these moving averages are working. So what are we if anything, what are we waiting for here? Not a reversal trade, but a with the trend trade, to be honest. I want to see the 50 fib broken. I want to see a hook back to the moving averages. I want to see a bounce off the moving averages. That requires patience, but there's nothing else we can do. I don't want to go long right at the 50 fib here. I don't want to take an early reversal trade either. So I'm neutral. I'm waiting and not trading this at the moment. Right? Anyone who took the trade just exited, in fact, at that take profit. Now waiting for a retracement back to the short-term moving average, and I'm waiting for a bounce off of those short-term moving averages for more upside. All right, so retracement and bounce, that's what I'm waiting for. That's the Aussie. So let's move on to it and look at the Kiwi. The Kiwi, I took a short right there, just a small one, looking for to add on, of course, when we hook back. This is more for demonstration purposes. So we're looking for a hook back and a bounce to add. The Kiwi was an example of a trend, a breakout. This is a breakout because the moving averages were intertwined here, indicating a range. What type of range was that? It was an ascending wedge. Why was it an ascending wedge? Because we had higher lows, but the tops were even, which is a typical ascending triangle. Ascending triangle, if it breaks the top, is a bullish signal. These are important chart patterns, and if you don't know them, it's very important to know them and learn them and practice them. My mentor said you need to practice hundreds of them. Each pattern. Go back in the past, draw them on the chart. Okay, some people say basically that you should be practicing and paper trading 2 or 3 times as much as real life trading. So if you're trading 4 hours live, they would say 8 to 12 hours paper trading, which I think is quite a lot. I'm not necessarily saying that that is a must, but I think the point is that a lot of people are trading too much live and not doing enough homework. I think that's the main message. I wouldn't necessarily say that you need to do 2 or 3 times. I think that's a bit overdone, but it's screen time, yes. Screen time. Screen time in the past, not only live trading. Because basically the idea is that by looking in the past, you learn quicker because you take more trades. Of course, these trades occur faster, and you don't have to display the patience when paper trading in the past with regard to the time element. If your trade takes 24 hours, it's a different living through 24 hours or paper trading it within 30 minutes or 15 minutes. You have to show the patience for 24 hours, or you have to show the patience for 5 hours or 2 hours for how long your trade takes. That's, of course, the main difference. But still, you can take a lot more trades. When you paper trade 3-4 hours, you can take a ton of trades, although those trades have less psychological impact on us. We could take tons of trades, whereas in real life trading, we are still stuck with one trade in our basket. So. Patience is important, but how do we create patience is through knowledge and experience. and how to create knowledge and experience is various methods, but one of them is actually applying concepts onto charts, both now and in the past, to see how they've worked indeed. So yeah, that's why it's important. Let's see. Kiwi breaking out because it was a range. Moving averages were flat, so there was a breakout trade. Break, pull back, and go. Let's see how far it can continue. This on the 4-hour chart though was not a breakout. It was actually with the trend trade, and the difference is because the moving averages were not intertwined, and that's the key difference in the definition. If you like those definitions, because price actually moved below the moving averages, that below the short-term moving average, then moved above it again. All in the meantime, the moving averages were had space between them. So this is with the trend setup. A reversal setup would have been somewhere in here, for instance, basically, or the break of this could have been reversal trades to the downside. We didn't get to the long-term moving average though. It's not a guarantee, as I said. We did have divergence between these tops, and when we have divergence between these tops, what is the minimum target? The intermediate one, and that's indeed what we reached. So we had an early reversal trade here at the top, from the top to the short-term moving average. Then the bounce was corrective, and then we got to move down back to the intermediate one. Classical reversal trade completed, and now we're getting a trend continuation. Is that trend reversal trade still in play? Is it a potential for price to make another reversal down? Well, not on the hourly, because the hourly, to be honest, we don't have divergence. We had divergence. It's not important anymore, though, on the hourly. From the hourly, we cannot say anything about it. It looks like a with the trend breakout. From the 4-hour perspective, we need divergence. We don't have divergence on the 4-hour chart. So for us to expect a move down to the blue moving averages is not within our scope. I wouldn't expect it. I wouldn't count on it. I wouldn't look for reversal trades right here, right now. It looks like a breakout, looks like with the trend setup. That's why I went long, and I don't see any reason why that should change at the moment. Of course, if price does get close to the resistance, price is going to struggle. It normally does when you come close to support or resistance. Not always does it struggle though. I mean, these breaks of the tops didn't really show any signs of stopping. We had here a couple of hours of sideways movements before we continued though. So basically, looking for, once we break this top, we have the green circle. Then we should see divergence kick in on the 4-hour chart, and then we know what the target is on the 4-hour chart, this blue moving averages. So this is how you can construct the path of least resistance on the Kiwi. You can say on the 1-hour chart, where I have the black lines, I have divergence here. Look, I have divergence. So price will most likely go back to the blue moving average, like it did. Then we don't have it on the 4-hour chart. So somewhere at support, we should expect a bounce, which we do. Then if we break above the moving averages, we should have a with the trend breakout. And if we break the top of the 4-hour chart, then we should expect a move back to the blue moving average. And you have spelled out an entire path of least resistance on this Kiwi, of which part of it has already fulfilled itself and become true, and the other, of course, remains to be seen. But this is what I could expect looking at the moving averages and understanding where the potential reversal trade could happen. All right, so I'll leave this on just in case you're multitasking. You can take a look at what I wrote on the screen if you want. Now, if you have any questions, let me know, because this is maybe for some of you quite a lot of material to go through or to digest. So any follow-up questions, of course, let me know. Where did the uptrend start? The 38.2 fib. Right, or restart. What is the target of that fib? The -272 at 87.40. So when I say when we break the stop we'll have divergence, it doesn't mean that 2 pips above it I'm shorting. No. Most likely the -272 target will get hit. And that will probably be the spot where we'll make that fall down to the blue moving averages in 3 moves. The first move will be from the -272 down to the short-term moving average. We'll see a bounce, we'll see a weakness, and then we'll probably see one more move down to the blue moving averages. will it be that target, or will it be a different target? If you want to be more secure, you could also actually use this fib anywhere in this zone. I guess 87, 87.40 could be the stopping spot. Most likely. That's what I'm looking for anyhow. That's where I'm targeting my own long trade, and that's where, if you're looking for reversal trades, that could be a zone that we could expect it. All right, so that's the Kiwi. Now, will this upside continue without pullback? No. But just because we might get a small pullback to the moving averages here doesn't mean I want to trade that. It's highly risky. We could get a small retrace, but most likely we'll see a bounce at these moving averages for more upside. Looking at the market structure, a high risk, small reversal scalp for 15 to 20 pips down doesn't make sense, no matter what trader you are. Looking for a long where I longed it yesterday, maybe you joined me, and hanging in there by trail stopping it to the target makes more sense. And waiting for a retracement to happen whenever it happens, it could be here, it could be here, it could be here, and waiting for a small retracement to go back to the short-term moving averages, the light green ones, and waiting for a bounce off price off of that is a good long, because that's what we're expecting. We're expecting continuation to get 4-hour break at the top and get 4-hour divergence, and that's why we're expecting the continuation to the upside, and waiting for the retracement to go and bounce off the moving average to go long makes a lot more sense than looking for a small retracement trade that might not even happen here. The retracement trade and reversal trade only makes sense when we break the top, when we have divergence, and when we hit the 4-hour targets. All right? So that's the Kiwi. Now the Aussie, if you like, as I said, if you get an interesting 1-hour candle, then that could be your potential reversal trade, right? As I said, I'm not a big fan of it, though. I'm not a big fan of reversal trades at all, especially the early ones. What I like to trade preferably are, if I trade anything, are bigger retracement trades, like the daily chart. For instance, this Aussie USD upside. Did I avoid trading it to the upside just because on the daily chart the moving averages are bearishly aligned? No. Right? So I don't mind trading this reversal trade, potential parts of this reversal trade to the upside. As I said, I took a long here for this target. So, of course, everyone, to a certain degree, no matter what time frame you look at, trades some type of reversal, or at least part of it, in most cases. But most of the time, it's on a higher time frame. The reversal trades on the lower time frame are just a bit more difficult, especially if you get to the 50-minute chart. The hourly can still work. As I said, look at the euro dollar, for instance. I had a very nice example here this fall. I mean, that was a nice space, sweet one. Wasn't a news event triggered one, but still, you get my point. Alrighty, let's keep on eyeing this pound dollar to see if it could make a bounce up. It's still in the struggle area if you look at these moving averages. The purple one, sorry. But despite that, that fact that the purple one is close, would have a reasonable expectation that we could see a bounce. Still, however, it's early in the day, and I noticed that if you're looking for, with the trend setups, they become a bit more reliable after the first 2 hours, after the first 1-2 hours of London. I like the trades personally between, I would say, roughly after the first 2 hours. Just before New York opens, or New York opens, seem to have the best, most, for an intraday perspective, the most, I like that session the most personally, but because there's already more info regarding today. Let's see. On Europound, there's a classical example of divergence here as well, right? We had divergence between these tops. Now, mind you that sometimes you can get double divergence before you get a bigger retracement on the hourly chart, okay? Or you might miss it just by a bit there. You see that? We had divergence between these tops, but we didn't get to the long-term, intermediate. We missed it by a few pips. Then when we had double divergence on this Europound, then we went down to the blue moving average and the intermediate one. Right, that's right here. Let's take a look at the dollar yen. Dollar yen, is the dollar yen interesting for trend or reversal traders? No. That's an easy no. Now, after maybe some of our discussions here, maybe some of you know the answer. Why is this not interesting? Why is this dollar yen not interesting for trend traders and reversal traders? Does anyone know the answer? Marius and Massier, apologies if I mispronounce your name. Yes, you're Mike or Mike are all correct. Richard too, great job. Yes. It's a middle of nowhere, Wave says. That's also correct. All of you are correct. Great job. Yes, it's flat. Moving averages are flat. Plus, there's no space between the moving averages, and the moving averages are intertwined. Prices in the moving averages on top of that. So it couldn't be. I think it's hardly possible to have it less active. It's as passive as can be, in fact, indeed, because all moving averages are flat. All moving averages are sideways and are on top of each other, plus prices in them. It's really quite drastic in a way. But if we put our trend lines on, you can see that basically this is happening and we're stuck in a range. So will this range end? I don't know. Is this, what you want to do if you're a range trader, this is interesting for a range trader maybe. However, you still want to make sure that there's enough space from bottom to top. And if you have 111, it's about 20, 30 pips. That isn't much space during the London session. And it's a bit dangerous to trade it, because once you get a confirmation of a bounce off of this bottom, before you know it, you're already at the top. So it's not a range that most traders will trade anyhow, and justly so, because it's just so tight. You still want, if you trade a range, you still want to have some space to make sure you got some decent equity and R2R expectation. This one doesn't have it. It is a range. It is a triangle. Is it worth trading the triangle itself? Not in my opinion. Is it worth trading the break of this triangle? Not in my opinion. Because if it breaks, there's a chance that it would be a false break. We hit this resistance right in here. We hit the resistance, make a down move. We hit support, make an up move. Anyhow, when the moving averages are this flat, what happens is that if price breaks away from them, they're actually at gravity. Price gets pulled back to them. And actually price overshoots them normally and again pulls back to them and then overshoots them and stays within this range like this. And the moving averages are right in the middle. Now, of course, at one point we are going to break away from it. I'm not saying. It's just that it could be take a few times. It could be very risky to trade. It could be a lot of losses before you catch the breakout. So what you rather wait for is wait for the break. Look how the break behaves. Look how it maintains itself. Is the break followed by a bull flag and another break? Fine. Trade the break of the bull flag. No problem. Or trade the break of the bear flag. No problem. Don't take the initial break here, because before you know it, you get a downside, you get a false break, and price is right back at the same spot, and you don't want to be in that trade. So dollar yen is absolutely not interesting on the 1-hour chart. It probably isn't interesting on the 50-minute chart. If anything, it's a bit bullishly aligned, because you can see the price here, the moving averages are on top of each other. So slight maybe preference from me on the upside. The 4-hour chart though is scary. This is scary in a way, because it's also right flat. Price, if we look at this, what did it do? Went back to the short term, went back to the intermediate, went back to the long term, and now is using the moving averages to support as resistance. And in the meantime, has flattened. Not interested in the dollar yen at the moment, no matter what time frame I look at. Let's take a look at the dollar CAD. Now, dollar CAD certainly surprised me yesterday, and just goes to show that despite the rules, those rules are not always 100%. Nothing is 100%. We didn't have divergence between these tops, despite the fact that we didn't have divergence, prices moving back to the long-term moving average. And I'll be honest with you, that surprised me. I expected with this strong upside, I didn't expect anything more than a retracement down to the intermediate moving average, and I expected the triangle to break to the upside. The triangle didn't break to the upside, it broke to the downside. What can you do? That's a fact of trading that also remains true. The chart patterns are there, and you never know 100% which way they will break. Of course, the with the trend trade was to the upside. However, we didn't break. We broke moving averages, and we are now filling up this space to the downside. And this is a reversal trade, a mature reversal trade. Although I would have traded it because when I traded reversals, I definitely want to see divergence personally. So I would have only traded to the upside. And there's nothing wrong with only wanting to trade one side. And if it doesn't happen, to skip that pair or currency pair. So in the meantime, we're using the short-term moving average as resistance. Do you see that? And price is pushing through the intermediate one and now falling to the long-term one. At one point or another, though, because we are still in a bigger uptrend on the 4-hour and daily chart, in my opinion, this is looking, if you look at the bigger triangle that we had here, remember that? The A, B, C, D, E. After this impulse, if you look at it from that perspective, I think there's still a good chance, a decent chance to bounce off the 61.8 or the 78.6 Fib for more upside. And you can see how powerful this concept is because you can use the entire idea basically on all time frames, and you can piece them all together to make a judgment where is the space that you want to trade on which time frames. It's really amazing how you can use these ideas to make a how do you call it, an analysis. So we're back at the long intermediate moving average. This could be a bouncing spot, but the confirmation of that would be when we break above the short term again. Whether we get a bounce here or not, we don't know. But when we do break above the short term one, then we have a breakout with the trend set up on the dollar CAD on the 4-hour chart to the upside. In the meantime, we could see bounces here or here. If we break below the support trend line, then in fact something else is going on. Maybe we get a bigger reversal trade even down to the long-term moving average of the 4-hour chart. All right, let's take a look at the Euro Swissy. Wei has a comment. Interesting observation here on the Euro Swissy. Let's take a look. Yep, good observation. Euro Swissy indeed made it up, move to the short term, then up to the intermediate, then up to the long term, and struggled at the long term. That's what you will normally see. When you hit one of these bands, you're going to see some struggle. You hit the band, you see struggle. You hit the band, you see struggle. You hit the band, you see struggle. And then you see a break above it, and then everything is starting to be aligned. Now we're getting on the hourly chart, we are already in an uptrend mode, absolutely. But what is uptrend mode on the hourly is still on the 4-hour chart a reversal trade. Isn't that wonderful how it all kind of fits in together? And you can see from the Euro Swissy we had divergence between these bottoms here. You see that? Like that. What's the first target? Intermediate. Then we made a hook back, and now we're going to its next target, the long-term moving average on the 4-hour chart. So if anything, it looks like we're getting close to a resistance spot. How far is that resistance spot? I would say it could go probably still a bit more, maybe to this target, for instance. Now, of course, this is going to sound funny, but this could not be, again, a resistance spot for more downside. Right? Then we finish this correction, and that could be, again, a resistance spot for downside. What would be the target? The target could be, for instance, the moving averages here. Just a very basic move back to the moving average. That's all. So there's actually a reversal trade to the upside going on, but the upside might run out of steam sooner or later. Wei is saying, for instance, 122.60, which is close to the 122.44. That's just within 15 pips, which is very little on this 4-hour chart. So roughly confluence there as well. So is there anything else to trade? Well, what we could do is, if we know that 122.44 is the target, or 122.60, we're not there yet. We're actually still 40 pips away. So with that said, you can zoom into the 50-minute chart and say, look, this is trending. This is up, this is up, this is up. They're bearishly aligned. There's space between the moving average. I could trade a with the trend continuation trade when this dips down, wait for the bounce, and take it up for some 40, 60 pips up to that resistance spot, and then maybe close out that trade, or close it then enter a short, or that, that's depends on the strategies you want to trade. So this is how you can see a with the trend setup on the 50-minute chart. You see a with the trend setup on the hourly. You see a reversal trade on the 4-hour. And on the daily chart, it's more of a mix, but it's still more of a reversal trade than anything. It's more of a range trade. It's already a bit of a minor reversal trade. Here you can see a classical example on the daily chart of the Euro Swissy of a range. Flat moving averages. Anytime the price tries to escape the moving averages, it bumps into a support or resistance, and it flies back, and the moving averages are a gravity. Now, though, price is trying to move away from them and looks like it's hooking back to them, but it's still early in the game. The pound odd is a great example of a trend. Now, I overmanaged my trade, unfortunately. Otherwise, I would have been up another 200 pips. And I didn't execute my plan as I really wanted to, because I wanted to re-enter here, which I unfortunately missed. Enter lower or higher. Didn't happen, and I missed 200 pips there, which is a pity. It's a lot of pips, but what can you do? It's a classical example, though, of how I was over managing. Not a good trading psychology part of I overmanaged, over micro-analyzed, and said, okay, this is at a bouncing spot here, potentially. I saw the pound dollar at the 61.8 fib. I thought that could get a bounce there. So odd USD was at resistance, so I thought, there's a good chance that this could fly up to the intermediate one and then find resistance. Didn't happen. Odd USD broke through resistance. Pound dollar didn't hardly bounce at 61.8. Well, I guess that's a bit unlucky as well. But point is that my original plan was to trail stop this using the 4-hour fractals. If I would have just used my own plan, I would have had a trail stop here about here, still be in the trade, right? Anyhow, next time. I have to learn from that. You can always make that mistake about overanalyzing. 50-minute world, very big trend. 1-hour world, very big trend. So how far can this trend go? If we're looking for reversal trades, we need to find where it could stop, basically. And if I look at this daily chart, because if you're looking for a reversal trade, what you need to find is a chart that has moving averages as a target. Right? What I mean with this is, if you look at the 50-minute chart, the only reversal trade that we can see is potentially like this. That's too dangerous. because we don't even have divergence on the 50-minute chart. Hourly would be up, would be the only way, right? 4-hour would be up because it's trending down. Here in the daily chart, we finally see that moving averages are below us in this downtrend. That's what we're looking for, to see where the targets could be. The target here is 178.28. If we put a fib on this very first downside, the very first momentum downside, and this three-wave correction up to the 61.8, what is the first target? The minus 272 target. Now that correction could see a sizable bounce of about maybe, let's say 140 pips. I mean, it could be even 200 pips. Could bounce back up to this bottom, for instance, these bottoms here. Then find rejection down again to the minus 618 target. Doesn't even have to be that big. It could just be a bear flag and then find its way down. So the more desirable reversal trade is off this minus 618. But the minus 272 could be one as well. Now actually we know that because we had daily divergence between these tops here on the pound odd, that the reversal target is the blue moving averages. So we're getting close to, we're at the target as we speak. In fact, not that I want to say that the reversal trade will happen right here, the bounce. We have a target a bit lower. I think that could be the level. That we might see a pause of this downside. Now, how do you know, and this is critical, that this reversal trade on the pound dollar daily chart is going to happen? How do you know that this is the top? How do you know that this isn't the top? Because we had that divergence already. Anytime we broke this top here, we already had divergence, right? So how do you know that it's happening here? How do we know that? And well, one thing, of course, as I said, if you look at the daily chart here, it's looking for candlesticks is the early way of entering. Now, we don't really see a very good signal until here, which is an outside bar. We did get some follow through there, but didn't get the bigger follow through. We still got one more bounce. Now, we did have a pretty big pin bar here. That's one way of knowing it, but it's a very early signal. We did get a good follow through. And we closed below the short-term one, right? And had a couple of days below it, which already indicates that, you know, this could be just part one of maybe a part three. First early signal. Then the next one is that basically, if you look at the weekly chart, the next time frame basically, you can see we hit the long-term moving averages here, first of all, but more importantly, which is the target, of course, for this gap filling trade here, right? Space trade, wide open space here. But more importantly, or just as importantly, we had 1, 2, 3, 4, 5, 6 candles not breaking this top. What is the definition of momentum? What is the definition of impulse? Every candle, or almost every candle, has a candle that is with the momentum. If it's a bullish momentum, that means most of the candles will be bullish, most of the candles will have higher highs and higher lows, and the bullish candles will be bigger. If it's bearish, it's the opposite. Look at this upside. Higher highs, higher lows. Each candle, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Each candle, right? That was an impulse to the upside. What is correction? A mix. Candles are not having a sequences of higher highs, higher lows, or lower lows, lower lows, lower highs. Most of the candles are mixed. Also, a idea when you have momentum is when the candle close is near the high or low, indicating no weakness, no wicks, right? So when we had, that's momentum. But when do we know that momentum is finished? When we don't have the candles breaking the high. If we fail to break the high or low once, that's okay. Twice is okay. 3 times even. 4 times. But if it doesn't happen 5 or 6, then usually speaking, we get a bigger retracement or some decent pause. Now, in this case, it was retracement. that depends on the market structure. Sometimes you get a bigger retracement, sometimes you get a bigger reversal, sometimes you get a bigger pause. But in any case, that upside momentum or downside momentum is over. And in this case, the sixth candle is crucial because it was bearish. And then you know that it's probably weakness, and this is a hook back for more downside. That's time factor. And if you then look at the daily, and this was the hook back of the weekly sixth candle, and that was an ideal selling spot for the targets down below. And we already broke below the daily moving average here, now again. So that was the ideal hook back. We had the time factor on the weekly on our side. We had the daily breaking below the short-term moving average, and this was a great fill-the-trade. And one short that we discussed for sure was right in here. That was actually the second hook back. This was the very first hook back, but that's difficult. This was a more confirmed hook back, and this was the ultra confirmed hook back. And now we're getting close to target. So we're getting close to our end of our session. Is there any particular pair you would like to see? We could take a look probably at one more. New Zealand yen is breaking with the trend. Pound yen and euro yen are not that interesting. Euro odd is falling like crazy as well. You see, every move here back to the moving averages was reason to fall, was reason for another downside. Very impressive. And every time that the currency retests the moving averages here, but fails to break one of these for the second time, or let's say fails to break one of these tops, we get followed through here. You see that? That's important because otherwise there's still the chance that price could actually use this and go to targets here. That sometimes can happen. Then we get an A, B, C correction. If the second time we don't break through the previous top, let me zoom in here. When we go here and we fail to break this top, then most likely the downtrend is going on. If we do break this top, then we have a chance of going to these targets. However, if, for instance, this candle, we see that there's a fractal here, then the chance that we have two fractals already, which means we have kind of like two tops already, and then the break of those tops to go to the targets is ultra small. So therefore, a short in here with these two tops in play is a good one. Now, sometimes you don't want to wait for that much confirmation, but sometimes you do get that confirmation offered by the market. So how far can this euro odd go? At the moment, we have with the trend a trend set up down to the downside. 50-minute chart too. Actually, the problem here is that it's moved too much. The currency has moved so much that we cannot trade it to the downside here. You can't take a short here because you're exposed to way too much risk. The chances that the price will eventually retrace are just too high. And the risks that are involved by putting the stop loss higher is just too much compared to the potential movement it could still make to the downside. So the only thing, if you want to trade with the trend, you can do is wait for the retracement and then wait for the bounce for more downside. If you're waiting for a reversal trade, then you need to zoom out to higher time frames and understand the structure of the market. And we look at this, we say, okay, price can go to the -272 target. Now it's actually at the blue moving averages, but the thing is, it broke this bottom, and therefore I think we're going to get some more follow through. So reversal trades is not really that interesting until we get way lower. And the only thing I'm interested in is really retracements for more downside. a retracement, for instance, that let's take a look. It really will depend on which time frame, because we don't have any divergence as yet on the hourly. When we have divergence, then we could finally expect to move back to the intermediate moving averages. So maybe we'd even have to look at the 50-minute chart. As soon as we get back to the intermediate ones like we did here, that could be another short. Eventually, though, be aware that we will get, on the 50-minute chart, we will get back to the long-term moving average. Whether that will happen now or later in the future, I would say later. I first think that we'll eventually go back to the intermediate, find one more downside, get divergence, then go up to the long-term moving average, then move down again. So by looking at this, you can see what trade you might find interesting. Yeah, these moving averages are basically using the EMA high, low, and close. High, low, and close. Okay, EMAs. EMA high, low, and close. Let me write that down. And the ones I use are 34 EMA, 136 EMA, and 554 EMA. It's a very, very powerful concept for analyzing the market, trading reversals, trends, and even ranges, understanding the market structure, understanding spaces, understanding where there is, with the trend, reversal trades, understanding the path of least resistance. Yes, these are bands indeed. I call them bands indeed. Yeah, indeed. Mike, I'm not sure what you mean. Is that a question? Those bands I just mentioned, the values I mentioned above there, okay? Does that make sense? So 34, 136, 544 EMA, and then for all three of them, high, low, and close. Let's see, Claudio is asking about the euro dollar. Yeah, that looks possible, although from my point of view, it looks a bit early still. It's still within the second of hour, which is a little bit early still. One of the things that is difficult at the moment is that they're still flat here. Now this could definitely be a resistance spot, I'm not saying, but it also could just pop back up here and move sideways. So one way of doing that is either taking a smaller position here and you have to accept if that doesn't work out. Let's take a look at the pound dollar, or because the pound dollar is actually bullishly aligned, so that's a bit funny today. Euro pound is moving down. The other way of looking at the break of this bottom, for instance, we get a break of that bottom, or if we stay below this level for a decent amount of candles like this, what we probably want to see is then another follow through, I guess, because then you have more guarantee that the price is not going to swallow back the price. I mean, the moving averages are not going to swallow back the price. What I don't like about the whole scenario is its choppiness. And what is scary about that is just because it can stay choppy. That's the problem. So I would have a bit more patience here still. See how the day develops. I think it's still a bit on the early side. technically speaking, we did break that level, but if I look at the entire structure, I would be waiting for more information, more confirmation. However, I did say if it breaks this bottom, but what I meant more is like it's a trigger. It's more like, I should maybe be a bit more careful with my words. It's not that I want to jump in a short immediately there, personally, but it is a trigger. It does mean like if we break this level that there's bearish momentum possible. Would I enter right there right now? I would still want to wait a bit for more information, personally. You can even take a look at the 5-minute world. What you're looking for maybe on the 5-minute world is if you have a move up to the moving averages here, and price then bounces off and then goes below it, for instance, and then you see some sideways move, then we could probably see a breakthrough to the downside. That's something that makes sense. Because if you look at the 5-minute moving averages, they're started to be pulled away from each other. So in that scenario, you want to see, I'm not sure which scenario I was talking about, Dave, but in this case, you're looking for an upside and then a bounce off of it. That is potential, but you have to realize that, in my opinion, everything at the $0 is still very early. I know that everyone wants to probably hear something different, but I'm not in a rush to personally trade the $0 because of the fact that it was very choppy before that. It's just, the moving averages are still flat, and there's no angle, and they just barely been torn away. So I'm looking for more confirmation and more information before I get some more guidance here. However, if you really want to trade the one way or another, then that would probably be the best. Wait for a hook back and a bounce off of it, and then we could see a fall. The other way would be to wait for, let's see, price to go, maybe price moving averages start to fall here, right? They're starting to move down, and if price goes sideways like this and makes a bear flag and then hits the moving averages and then bounces off, that's another way. Price doesn't have to actively go to it. It could be price goes sideways and then hits the moving averages and then bounces off of it. That would be another scenario. Or if it does break this bottom, then pulls back to the moving averages and bounces. I would probably still wait for the move back to the moving averages. But then when we do break this bottom and then hook back, the moving averages are already torn apart a lot more, which is good. You can take the break of this bottom, but most likely you're going to get the same price if you wait for the pullback to the moving averages. So the main message, I guess, is tactically wait and be patient for clues. You don't want to be too late. I don't mean you want to start trading right at the London close. I mean, then it's too late, obviously. But maybe a good expression is, the early worm gets the early bird gets the worm, but the first mouse, what was it? How does it go? Gets the mouse trap or the cheese trap, right? So my point is, I know it's a stupid example, but point is, you want to be too late, but you don't want to be too early. I think it's with Forex trading too, in a way, because if you commit yourself too early, you could get trapped. And you want to see the direction, you want to see the flow first, and then try to trade the bounce with the trend for the intraday trade here if you're trading intraday, or the bounce anywhere, no matter what time frame, in fact. Alrighty, folks. Well, I guess that will wrap it up for today. And hope you enjoyed this reversal trading webinar. And we'll be back, or Toronto will be back later today at 5 p.m. GMT time, he'll be taking a look at, I forgot which topic to be honest, but an expert advice topic. Tomorrow we got a live webinar, of course, same time, same place, and then we have the Forex strategy explanations in the evening, 5 p.m. GMT. So hope to see you then, and wish you all great trading and a great day. Cheers.
The organizer